Okay. All right. I'm going to try and be brief so we can get all this in and we can have some discussion. But I titled mine, my section, "The Great Financial Crisis: A Historical and Class-Based Perspective." And basically, I have two things I kind of want to get across. I want to situate this our current financial crisis historically, and basically put it within the long-term macro-structural transformations of the U.S. and the global economy that we've undertaken over the past 30 years or so, since 1970s. And second, I want to dispel the notion that this financial crisis is just that, a financial crisis, and that is limited to the financial sector. And kind of some of these explanations that we get from the news, whether it has to do with heightened CEO pay or just greed in the market or whatever all these kind of piecemeal explanations are. And I want to kind of give a more systemic overlook of some of the conditions that led to our current situation. So with that said, so as far as the historical context in which we need to understand our current crisis, we need to go back to the 1970s, and actually before that, to the period before the 1970s, from 1945, or you can place it at different dates, to basically mid-1970s. And one way to characterize this is to call it what people refer to as a labor-capital compromise, and basically a changing idea of what the relationship was between government and workers and capital, etc. And so these are characterized by things like Keynesian economics, active involvement of the government in the economy, financial regulation, increasing wages, led to the rise of the middle class in the United States, all that kind of stuff. Okay, so this was the period leading to, and I put 1973 as basically being the turning point. Marxists call this an accumulation crisis, and I'm not going to go into the details of what leads to an accumulation crisis because that would take forever. There's different arguments about whether or not it has to do with falling rate of profits or stagnation or increased competition from abroad or whatever the explanation we want to run with is. What we do know is that something switched. Something changed in the 1970s, and so whereby we can say from the 1980s to the present we've had changes in the overall macro-structural economy. And these have been characterized by three terms. We're probably more familiar with the first two, globalization and neoliberalism. These have kind of, and sometimes they're put together as neoliberal globalization. And while these terms are all interrelated, I think I'm going to concentrate on financialization as being one aspect of these larger macro-structural changes and how that led, and not only, I'm not going to get into the details of how they led to globalization and neoliberalism, but it as being a fundamental aspect of these changes, okay? So let's start with just a definition of financialization. And I chose to give basically the simplest definition because it kind of plays into what I'm trying to get across. And again, I'm going to try and keep this simple. So financialization, referring to the shift in gravity of economic activity from production to finance. Basically, this is just the idea that capital accumulation in the United States, which I've got a graph here, from the 1970s onward, picking up speed in the 1980s, turned towards financial profits as opposed to investing in the real economy. Real economy meaning the productive sector, the idea. And this is, again, part of globalization, deindustrialization, all these kind of changes that we associate with what's gone on over the past 30 years. But it's this financial, this growth in financial profits that is most important for understanding not only our current moment, but also, the trend that got us here. So, and so, what did I have in the next one? Okay, so the question becomes why? Why did we start to invest in financial speculation instead of investing into the real economy? And that's kind of what I want to get at, or I want to give an explanation that I've found to be increasingly convincing in terms of its ability to explain this shift and why we no longer invested into producing things, commodities, but invested into speculation. All these crazy instruments that John was talking about, derivatives, hedge funds, things that nobody understands, but nevertheless were the means by which capital could continue to accumulate, okay? So the explanation that I'm going to kind of concentrate on has its roots in a 1966 publication by Barron and Sweezy called Monopoly Capital. And there's a lot in this book that I'm going to kind of gloss over, but I want to get this main point across that is the crux of their argument, and is that this idea that there's a tendency for the surplus to rise under monopoly conditions, and that this surplus, the whole idea of capital is to generate this surplus. But the problem is that this surplus needs to be reinvested back into productive capacity. Their argument is basically as capitalist economies mature and as they grow from the competitive stage into a more, as Marx said, they would increasingly become concentrated over time, that they would increasingly become to be to characterize monopoly conditions. And this can be confusing too, because it doesn't necessarily mean that there's no competition. It's the form of competition that changes, away from price cutting and more towards different types of competition. So, but the basic point to get across is that over time there's this tendency for surplus to rise. And this surplus rises in relationship to the effective demand within the economy to invest it. So you have this rising bulk of surplus that needs to be reinvested back into the economy. But as competition ceases, as industrial societies mature and become more concentrated, there are fewer and fewer outlets for that rising surplus, and that this ultimately results in stagnation or a slowdown in economic growth. And so they basically say that there is a tendency towards stagnation in mature capitalist economies, and that what needs to be done is that there has to be active intervention in order to deal with this rising surplus. And so that this rising surplus you can do all sorts of things with it. Part of what they say is done with it is increasingly pushed into things like the military-industrial complex, imperialism, things like that. Also what they call the sales effort, increasing concentration on advertising and all this kind of wasteful spending that we're exposed to every day, but nevertheless doesn't actually produce anything. And then, what else do I have? Okay, and okay, so I kind of got ahead of myself there, but the whole point here is, like John said, that we increasingly have this global pool of money. He mentioned a Krugman article earlier this week in which his conclusion in this article was that desired savings exceed the amount businesses are willing to invest. And I read this and thought, well, Krugman's an overaccumulation theorist as well. Because basically this is this idea, there's a global pool of money and we just need to find somewhere to put it. And so the question becomes, why don't they put it back into productive capacity? The monopoly capital argument is that they're already saturated and they're already running. And so they look at a few figures usually, and we can see that since the 1960s, net private investment into fixed investment as a percentage of GDP. This is what private enterprise is investing into our economy. And we can see over time that this decreased. So another thing that, I'm going to skip that one. Another thing they look at is percent of utilization of industrial capacity. This is the idea that our industries aren't running at 100% capacity. They're running at something below that in order to produce for a given profit margin. And so if you're already running at 60%, it doesn't make much more sense to reinvest back into that original productive capacity to sell more goods that you're already running at a lower rate. So this is kind of some of the information that they point to as evidence of how we can see that there's this saturation within the domestic economy and the global economy. It's not just the United States, even though most of this research focuses on the U.S. domestic economy. Okay, so basically the argument here that's been put forth in recently by some of the people building off of Barron and Sweezy's initial monopoly capital is that of that increasingly since the 1980s that this surplus, this money, was pushed towards financial speculation. This was the primary means by which they could overcome stagnation in the underlying economy by feeding speculation, expansion into all these different financial instruments. And so instead of Marx's original formula of MCM, money going into commodities to produce more money, they divert the C, and it just goes money to money. It's speculating on money and creating money off of, it's fictitious money. It's speculation into claims of wealth, okay? So hopefully that wasn't too confusing.